Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. All right, let's get episode 2 up and running. In this episode, we are going to start looking at the philosophical difference between growth and income portfolios and dive a little bit deeper into the growth portfolio, and we will leave growth behind at the end of this episode and start going into income portfolios and designing yield after this. So let's take a quick jump and wait a second. Before I do that, I just want to make sure that I make it clear what I am doing is educating you. I do not have an ulterior motive. I certainly am not asking you to trade one way or the other. All those are decisions that you make. And like all humans, I probably will make mistakes, and I'm happy to learn from them. And I would love it if you give me feedback and we can all learn together. So in this episode, as I mentioned earlier, we're going to start looking at the philosophy of growth and income portfolios and take a closer look at the growth portfolio, what kind of assets are in it, and then pick a brokerage account and start understanding how to screen for growth stock. And we'll focus on equities, and we'll look at how to screen for growth stock in this episode. So let's get started. Hi there, growth investors. I thought you would relate to the story of the humble, tiny little lobster. The tiny lobster has an exoskeleton that literally prevents it from growing. And the lobster goes through inflection points, very much like a growth investment does, and it breaks through that shell and gets bigger and bigger, only until it breaks through the next shell, and so on. And growth investments are like that. Some of them go on to produce magnificent results, but there may or may not be problems along the way. Not all lobsters become big and end up on your dinner plate. Some of them end up on someone else's dinner plate. And that, my friends, is the contrast between growth and yield investing. Yield investing or income investing is like tomato farming. You control a couple of key variables like good soil, sunlight, and water, and your odds of producing yield are very, very high. Not only that, you don't have to wait for an event like in growth investing for years with great uncertainty. You can pretty much start picking your tomatoes in a few weeks after planting, and every week you can start taking more of your yield out and build your return over time. However, the risk versus reward also has a similar pattern. Whereas growth investing, or a lobster in our case, produces $30 a pound, yield investing only produces $5 a pound, but you get your yield every day over the course of time. Okay, now that we have a basic understanding of the difference in philosophy between growth investing and yield investing, let's do a quick recap. Growth investing is similar to lobster farming in the example or analogy we used, and yield investing is similar to tomato farming with two big differences. What is the time to yield in general, and what is the predictability, with the time to yield being shorter for yield investing, the predictability being higher for yield investing, however, the potential yield itself or the return itself being much greater in growth investing when you are successful. In addition, growth investing generally has the profile of a higher risk and higher reward, while yield investing is lower risk and steady income, where risk mitigation is the key. Now that we have reviewed the philosophic difference between growth and income investing, the question is, which one should you pick? And the answer is, in a way, both. Experts will tell you what you really need is a recipe. And continuing with our analogy, you probably want some lobster or growth investing, some tomatoes or yield investing, maybe add spaghetti and whatever suits your taste. As a vegetarian, I need the impossible lobster or the beyond lobster, but I am now diverting away from the topic. Anyway, Let's talk about how a growth portfolio looks like. I figured when somebody comes and pitches you an idea, it would be really helpful for you to think through how does a growth portfolio look so you can say, I know this one. It's actually pretty easy. All you do is apply a smell test and see if this is something that you think is a good idea. So let me give you an example. Pretend it is 2007, 2008, and I came to you and said, hey, remember your lovely 19-year-old daughter that you dropped off in college? It's 2 in the morning, she's downtown, partying with her friends, she's getting done at the bar. I was gonna send this dude. You don't know him, actually, I don't know him either. And he's gonna pick her up at the bar. She's gonna give him her phone number. She's gonna give him the exact address where she lives. And he's gonna take her home at 2 in the morning. You should feel really good about this business idea. As a matter of fact, if you give me $10,000, I'm gonna take your 10,000 and I'm gonna make it into 5 million in 14 years. Sign here. How many of you would have actually done that? The point I'm trying to tell you is that even though we can sit here and create theoretical representations of how a growth investment looks, it is very hard to think about and analyze it. Having said that, let's see if we can put some structure into the growth portion of your portfolio. One big caveat: remember that at the end of the day, the growth portion of your portfolio is a well-educated journey in chance and trusting others. So having said that, let's talk about what needs to be part of a growth investment. The very first thing you're going to look at when you kind of kick the tires, so to speak, is to see if there is some net income. Maybe the company already makes money, there is some level of profit. They may be pre-profit, sometimes they may be pre-revenue. They may have a certain amount of cash in the bank, or you are the person putting the cash in the bank. They may be buying and selling things, generating some operating cash flow, and you might be the new round. They are going to use that proceeds in one of two ways: either to build new products, new services, maybe they need to upgrade their infrastructure, or they are an acquisition based company, or they are trying to expand internationally. That in general is one of the components of a growth investment. Now, why would anybody give money to do one or both of these? Very simply because they want that company to generate new revenue, increase their profits, and remember our lobster story: break out of that shell, break out of that inflection point, and become a bigger lobster. And when that lobster breaks out of that shell, it goes right back to the top, generates more net income, puts more cash in the bank, progresses towards cash flow positive, and continues the cycle. You, the growth investor, are continuously betting on the engine to keep growing and growing and growing until you are ready to cash out or until the company itself has a transaction. So, what needs to be true for a company to ideally be able to go through this cycle? Let's look at a couple of things. One, hopefully the company has a true landmark innovation. A lot of companies are out looking for cures for this kind of cancer or the other. Some of them say, I have a better battery. Whatever the promise is, the promise has to take you leaps and bounds beyond what is available to give them a good shot at taking over the market and generating returns for you. The next part of it is maybe the company is already following that promise, but they are expanding so fast, creating so many new products that they need your cash to go faster in that trajectory. And last but not the least, the company may say, hey, we are an acquisition based company. Our growth comes inorganically, as it is called. We're going to go outside the US. We're going to, within the US, buy our competitor, and we need your help to become larger, to get scale. And that is fundamentally the DNA of a growth stock. All right. Now that we have covered this much distance in episode 2, we're going to take a break and pick up the second part of episode 2 in another lesson. Thank you for staying with us. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.